It looks great, David. Over to you.
Okay, thank you, Sri. Okay, thank you everyone for participating for tonight's webinar. And also we're delighted to have a representative from CME today to be on the call with us. So I think today's topics that the commodities I'm going to cover is mainly on gold, and I think everyone is been talking about where do we see prices for gold, and it's been quite a topic of late. So I think therefore in the next 30 to 35 minutes we're going to cover some of the major news flow that actually that comes into the gold market as a whole. So just a general risk disclaimer. Whatever I present here means mainly for educational purpose. So if you want to know more in further details of the product, please feel free to reach any of my colleagues, or even you can drop me an email and I'll address those questions thereafter. Now, this is the agenda. In the next 30 to 35 minutes, we'll be talking mainly on what are the global sentiments that's affecting the general market. How do we see the global markets as a whole affecting gold prices in general? And secondly, we'd like to talk about China, because China has been quite a commodity market player of late, and the significance of China in the commodity space has been quite significant over the past couple of years, and we'd like to address that, and we'd like to show the audience the significance of China in terms of their commodity demand. Thirdly, we will touch on seasonality pattern. As every other commodities, gold is no difference. Commodities in general tends to show a seasonality pattern that's repeated at most times. And we like to show the 20-year cycle for gold prices in terms of their seasonality, and we will look at it later on the slides. And last but not least, we would like to show the audience on why do we need to engage, or if you want to get an exposure in the gold market, why futures is an important, or in fact is the best instrument there is out there for you to gain a leverage in terms of the gold exposure. Now, just to show you the performance of gold of late, here we can see there's the Thomson Commodity CRY Index, which is tracked by the green color line, and you have the gold price index, which is tracked by the yellow line. And you can see of late, for the past 2 or 3 years, gold has gained significant price appreciation compared to other commodities basket. So in fact, gold is quite a major outperformer. On this slide, we are showing you gold against other basket of asset classes. True enough, I think for the past 2 or 3 years, we have seen significant gains in the equities market, especially equity markets related to the Western economies. But if you just look at gold, gold didn't fare that bad either. So since 1971, gold has been greatly outperformed other asset classes. If you look at comparing to bonds or even emerging markets equities, I think in general throughout the 20-30 years historical period, gold has generally been doing fairly well, and what we believe is that continue towards the next couple of years, gold will continue to be another top performer in terms of asset classes. Now, if we just we break down prices into year by year, and we just assess the volatility in the gold prices of late, we can clearly see that gold price in general has been quite steady. If you just look at the price change for gold on an intraday basis, for the past couple of years, we have seen a steady declines in terms of volatility. So in fact, if you look at it, we do not expect much price change or price volatility on a single day. And I think if you just look at the overall picture for gold prices, if you track the gold prices for the past 2 years, we have seen a significant trend. It's clearly an uptrend for the past 2 years. And I think the momentum could be sustained as long as the demand fundamentals for gold still remains relevant till now. Now, you may ask, if you just look at gold prices for the past 6 months, how has it been faring? And we are seeing gold prices climbing from $1,200 US per ounce going to $1,300 US per ounce over a short period of a year and a year half. I think the major driver that drives gold prices in a short term was mainly due to the inflation that we're seeing in majority of the Western economies, especially in US. Just recently, just last week, we have seen how Federal Reserve has just increased or hiked the interest rates as a response towards inflation. And actually that is also supportive for gold prices in general. We have seen gold prices climbing above 1,003 and it's trying to hit for the next resistance at $1,400 US. So this is one of the key drivers that support gold prices is definitely on the inflation level that we're seeing in majority of the developed countries. Now, if you're comparing in terms of overall, we can clearly see gold has been faring very well against inflation. And if you look at it historically since 1970, gold has been a best performer of asset class when it comes to inflation. And if you just look at it when we are suffering high inflation levels, and we define high inflation level here in the sense that it's above 3% in terms of inflation rate, and clearly gold will definitely be a performer, and gold will rise in this kind of circumstances. So do watch out, especially we are facing a rising inflationary environment, and I think gold will definitely be performing in this type of environment. Now, so that's in terms of inflation being a gold driver in terms of gold prices. Now, what other drivers that can actually affect gold prices? I think one of the key drivers is actually still back to demand and supply. Just like other commodities, demand and supply are the key driver that determine your price in the market. Now, secondly, we also look at global sentiments. I think global sentiments here referring to global market sentiments, which is coming to play off late. And I think that will gain a bit of traction moving forward. Because as markets becomes more volatile, becomes more uncertain, gold will usually be a safe haven asset. Then thirdly, interest rates. Now, in this aspect and in this angle, it gets a bit more interesting. I'll elaborate later on further on my slides. And last but not least, geopolitical tension. When it gets heightened geopolitical scenario around the world, I think everybody will rush to gold. And I think if you just see the news flow that you're seeing in the geopolitical space, clearly we are seeing many people are also fleeing to safe haven assets. And I think in this respect, gold should gain a bit of traction. Now, let's start on the first key driver. The first key driver, you look at the demand and supply. Now, supply for gold is quite constant. As you know, gold is finite in resources. You'll be a certain amount of quantity that's available around the world. So there's not much change or not much growth to the overall supply of gold. However, for the demand side, it's a bit interesting. You just look at the three major demand for gold. One of it is central banks, another is technology demand driven, and the last but not least is jewelry. Now, if you just compare last year and the year before, we have seen a significant increase in gold demand coming from central bank. And if you look at it, one of the major economy that's buying a lot of golds and is putting their golds into the central bank reserve is mainly China. And we recommend investors who keen to follow on the gold space to watch out China buying of gold, because it becomes very significant over the past few years. And we reckon that this momentum will still continue and is actually a key support for the market. I would elaborate further on what's the reason China is primarily buying a lot of gold of late. Now, here again to emphasize the role of gold. Firstly, is as a safe haven assets. So again, when markets becomes uncertain, they are not sure where the future direction will go, and a lot of people rush into safe haven assets, and in this case will be gold. Secondly, in terms of physical, that will be primarily on jewelry demand. Now, India and China is still the largest market, or rather consumer, in this space. And central bank buying is an important element, and it's worth paying attention because, especially if you look at China, they have been buying a lot of gold off late, and I think that really should be an eye opener if you're really looking into the space. I'll just to show you the breakdown of different countries in terms of jewelry demand. So clearly sitting on top of the chart is still China, followed by India. Now, if you look at the pace of India and the pace of China, China has been aggressively buying a lot of golds in terms of jewelry demand over the past couple of years. But India, however, on the other hand, looks a bit, the demand growth is lackluster off late. I think India slowly will be being taken over by China. So China is still a primary driver in this space, and therefore it's worth to watch out. Now, this is the chart that I'm referring to, central bank buying. So this chart shows you that total China gold demand in their reserve. And you have seen how they have climbed over the past decade. It's actually tremendous. So right now, sitting on their reserve, China is actually having 2,000 tons of gold sitting on their reserve. And if you compare to other countries or other developed countries, the United States is still the biggest in terms of absolute number, but China is slowly coming up. Just a couple of years back, China sitting in their reserve were probably less than 1,000 tons. But now, this is just off latest figures, 2018, they are probably having about 2,000 tons in terms of absolute numbers. So China is clearly buying a lot of gold on the open market space. And I think they're gearing up for more purchases going forward. Now, economic conditions. And economic conditions here refers to sentiment, global market sentiment. And we believe that in this space, it is going to get very volatile, and therefore gold will be the ultimate beneficiary. So this chart shows you the S&P 500. So you can clearly see S&P 500 has broken the triangle formation in terms of technical charting, and that creates further downward spiral for the S&P 500. And in the past couple of days, we have seen S&P 500 broke a lot of major support. So clearly, equities market are witnessing a correction. And in doing this kind of circumstances or this kind of scenario, gold usually will be in favor. Nevertheless, to say it's not only in S&P 500. If you just look at Nasdaq itself, some of the key major tech stocks also face decline in prices, especially the key Nasdaq tech counters. So clearly, US market in general is facing a little bit of correction during the past couple of days, and I think gold could be in favor, especially when it comes to this kind of market. Now, what explains the recent devaluation in terms of the equity markets? I think clearly a lot of people are saying that the US market is being oversold, the valuations are stretched, so therefore investors are taking opportunity to cash out. But if you just look at this is just a stress index that's being tabulated here. It's gotten from US Treasury Office. What I want to show you here is that if you just look at the stress index, how low is below the zero line. It's actually negative territory. If you just relate this back to before the global financial crisis, and you just look at on the chart itself, the negative stress index was actually repeated in year 2007, and right now is approaching to that zone as well. So what this tells you is that the market is generally very calm, and in fact, market is expecting no risk, or in fact minimal risk in coming months. But usually when the situation is calm, it spells trouble. So this is exactly the point in time where we are seeing just before the global financial crisis in 2008. Would that happen again in the next couple of months? We won't know. But what this tells you is that this is something for investors to prepare. And usually in this situation, if you expect market volatility to return, gold could be a hedge or a safe haven in this scenario. Okay, just to reiterate the point again, if this is S&P 500 Volatility Index, or VIX for short. So you can clearly see VIX has moved up a huge scale. It has broken up the top resistance. So what this tells you in short, you should expect more volatility in coming days. And in this kind of scenario, when markets are getting very volatile and the direction is uncertain, I think it's good, even as part of your portfolio, to have gold to hedge a bit of the price risk, so that to moderate the price fluctuation in any of your portfolio. Now, the third key major driver, and it's an important driver, okay, and I think in this space we have seen a lot of news flow coming in especially from US regards to interest rates. I think many talks in town is talking about at least 2 to 3 hikes of interest rate in US this year. So this interest rate is another critical area that we have to watch out. We are still seeing at least 2 to 3 more rate hikes in the next upcoming FOMC meeting. And when it comes with interest rate hikes, you have to watch out on a dollar. And in regards to dollar, you have to watch out on the gold space. Now, another critical point to take note now, especially if you are trading on the gold market, if you have seen clearly how interest rate has risen in the past couple of weeks, and how we relate that into gold prices, it doesn't really jive. The reason being is because usually in a rising interest rate environment, gold usually will not be in favor. In fact, we should see decline in gold prices, but we have not seen that. So this is something to watch out, and it's very interesting. If you are trading a gold market, and if you are just basing on this relationship, you should be careful going forward, because the scenario has changed, the tide has changed. I think gold in general is being well supported because mainly coming from economic uncertainty that traders are expecting. So do watch out. If you're trading based on this type of relationship, we have to be very careful when it comes to linking interest rates as well as linking interest rates to gold prices. Okay, this the much concluded FOMC event last week has confirmed our point that we are really looking at 2 to 3 rate hikes throughout the year. So if you just look at the Federal Reserve dot plot, we are looking at further increase in interest rates for the next couple of months, or in fact, if you go into 2019 to 2020, in the next 2 years, we should see rates approaching as close as 3% in US. That's pretty steep. And when we see rising interest rates environment, you will definitely put a lot of pressure in terms of your debts. And US being a huge country with a huge amount of debts, this could be an issue. Okay, this is just to show you what happens when interest rates are rising and it affects your yield. So clearly you can see interest rate rising yields the bond in some of the major markets. Some of major treasury bills are already rising, and this could actually be attributed to higher servicing costs for the US government. And this could potentially be creating further economic uncertainty and further risk to the economic system. Okay, now just to reiterate my point, here what I plotted is the blue line is a dollar index against the yellow line, which is your 10-year treasury yield. So you can see there's a very wide gap, and it's actually a sign of concern. We are seeing a falling dollar. We are seeing a higher interest rate environment, higher yield environment. All in all, the net effect will be negative for the US economy in the long run. The reason being, because as we head into a high inflationary environment, and if interest rates are not rising fast enough, are not able to contain that inflation, and we bound to have a risk of recession sooner or later. So this is another space that we have to be careful, another angle that if you are investing or trading in the US market, the fundamentals in the mid to long term doesn't look really that well. So in a short term space, we still get to see a bit of rally, but when we move to mid to longer term, I think this is a space that we should be very careful of. Okay, so just to reiterate my point, 10-year treasury yields are moving higher, inching higher. This is due to the effect of higher interest rate. And if it's actually broken the top resistance line in the US treasury, so this is another space that we should watch out. With higher interest rate expectation, yields in the bond market will generally be higher. And therefore, that will translate into higher costs for the US government to service at the end of the day. Now, you just look at how the pace of US accumulating their debt, it is actually quite a dangerous precedent. If you just look at US debts over the past couple of years after the global financial crisis, it has actually accumulated a lot of debt. And eventually this debt, with higher interest rate, it means higher servicing costs. And it becomes very important for US to actually gauge how far can the economy grow, because that will determine whether they are able to pay off at least part of their servicing costs. Now, with that regard, the risk of recession will get higher. The reason being is because if interest rate rise, we definitely the US government have to service with a higher amount of loans, a higher amount of servicing costs. And if the economy doesn't pick up that fast, and I think the economy could fall back into a recession. And that will prompt the Federal Reserve to make further action, stimulus action. And one of the key stimulus action that they can do is either to reduce or cut interest rate. With current interest rate that you are seeing in US, which is about 1 to 2%, is still relatively very low. And if there is a risk of US falling back into recession, the amount of room for US to cut their interest rate becomes very minimal. In fact, if you look at it, the decision to hike interest rates for the past couple of FOMC meeting was pretty, in a way, a little bit too late. In fact, US Federal Reserve should cut interest rates way before, when the economy was still on the sound footing. So this is a big risk that we are seeing in the market. and this could potentially be a game changer. Okay, we have seen how the equities market rally. So the thing that we have to take note is that the debt in US is actually getting higher, and the servicing cost could be an issue sooner or later. Now, this is just to look at the credit conditions. So you see federal funds rate increasing, which is denominated in higher interest rate environment. So credit spread is going to get higher. Now, credit spreads here refers to the spread between corporate loans and against treasury. So once that spread gets higher, it'll be a burden for a lot of corporate companies in US to finance their debt. And therefore, the risk of default is going to get higher. So this is another space that's worth watching. If you've seen how fast the spread recent doing before the financial crisis in 2007, we are seeing those type of growth right now, but we have not seen the level of risk default that we used to see back in 2007. So I think companies now are sufficiently, they have sufficient liquidity to weigh off any increase in their funding. But again, you are now seeing a higher interest rate environment, higher level of interest rate that they have to pay. So corporates will definitely feel the pressure. So this comes to the question to the default rates that we're seeing in US. If the default rates in US keep climbing higher, I think that could spell for more trouble ahead. So do watch out on this space. As Federal Reserve keep increasing the interest rates, the spreads will get wider and wider. Now, just looking and detail some of the majority of US debt, I think there's a common perception that US General has a huge debt, but majority of their debt is still between the treasury side of things. But if you just look at things in detail, majority of US debt is not only in terms of mortgages or housing loans, but if you break down into the debts category, even others debts like student loan and credit card debts are also gaining higher in proportion over the years. This is actually a sign of concern because generally in a healthy economy, as long as the economy pick up in speed, student loans, credit card, in general will record higher loans amount. This is healthy in terms of as long as the economy is still growing. But the question is, if economy in US start to slow down in terms of the GDP numbers, now then this could be a question again. The student loan and credit cards are pretty prone to the general economy health. So this is another area in terms of the debt economy in US, and it's worth watching because we are now facing a rising interest rate environment. So all these debts that are being out there, it's going to definitely feel a bit of pressure. So again, this all boils down to the default rates. If you're an investor, if you are tracking on the US economy, do watch out on this space, as this will mount as we go further forward into months. So how this is going to play out is going to be critical. So this is just to show you the rising corporate yields. Definitely, it's not a good thing. Rising corporate spreads between the company and the treasury is going to put a lot of pressure on companies. We still, based on last quarter earnings report from some of the major US economies, it still seems that US economy is still growing, but at a fairly slow rate. And the question that we need to ask ourselves as we move to quarter 2, quarter 3, will this growth be sustainable? If this growth is not sustainable, then this could be an issue. As companies do not grow enough or fast enough, then they could face a risk of defaulting on their loans, and that could spell further trouble into their economy. Now, this is just to show you again the commodity index against the dollar index. We have seen a commodities rally for the past couple of months, and this was it was mainly attributed to the weaker dollar. So we have seen a weaker dollar is always benefiting the commodity index in general. And I think this is fairly something for us to take note. And we foresee that the weaker dollar will continue, especially dollar index continue to go further south. And I think that will benefit the commodity basket in general. And in this regard, it's also benefiting gold, as gold has an inverse relationship to dollar index. Okay. Now, I think towards the last part, I would like to talk about US dollar, the relationship between US dollar and gold. But before we move to the last driver that drives the gold prices, I would just like to take a 2 minutes break just to receive questions from the audience before I continue.
Do feel free to type in any questions that you may have in the question box, and David will pick them up. Gold, as you can see, is a very interesting topic with many of our investors tune in to the movements of the prices for this precious metal. So do feel free to let us know if you have any questions. Just type them into the question box, and we will pick them up. In case if you're wondering if this session is recorded, yes, it is. So you will get a link to the video so you can revise what we have covered in today's webinar at your own convenience. So you do look out for the link in our follow-up email to you likely tomorrow, and you can revise what we have covered in this webinar.
Okay, I see the questions coming. So I'll just start to the last few parts of my presentation. So for the next part, I'll probably cover how dollar actually affect gold in general. And I think one should really look at dollar at the current juncture, because I think if you just look at the dollar position itself, over the past couple of weeks, we have seen the weakening of the dollar against many major currencies, and actually that's a sign of concern. And the ultimate beneficiary again for this is definitely still gold. So on this chart, what I show you here is the hedge fund positioning for the US dollar. You can clearly see that majority of the hedge funds are still holding short on the dollar. And I think many of the major corporate institutions are looking at further downside on the dollar index, especially when it's against other major basket of currencies. Okay. And if you just look at FX volatility, this is across many of the major currencies against the US dollar. Even though we have seen the sharp decrease in dollar index, but if you just look at the change itself, we still see it at a really tight range. We don't see much of volatility in other basket of currencies against the US dollar. So this is actually an indication of whether is there a threat of currency war. Now, when it comes to currency war, I think this is something for us to take note. We can clearly see the recent actions by the US government on the imposition of steel tariff. I think that could have an impact for the dollar, especially for the midterm towards the long term. So on this base, the currency war, especially US dollar against many of the other major currencies, should be watched. And I think as long as we don't see any major decline in other currencies against the US dollar, it's still safe to say that the currency war has not really started yet. But eventually, if the trade sanctions or even the trade tariffs are being imposed by so many other major countries that has a relationship with US, that could have an impact, and we could see some sort of currency war sooner or later. Now, just to reiterate my earlier point, if you just look at how dollar position has been in the market, majority of the institution, as well as even to a certain extent the retailers, are still holding short on the dollar itself. So I think many of the people are still expecting that the dollar will still head further south. Now, this is an interesting chart, I would say. This is comparing the strength of many other major currencies since the 1900s, from towards the current years. Now, if you can see that 1970s, we have seen almost a collapse of other major currencies against gold. This is referring to the gold parity, whereby I think the convertible of many other currencies to gold. And in if you remember in history, the Bretton Woods arrangement, you've seen how gold, uh, gold, gold relative price to other currencies value has actually plunged, because of the convertibility of gold to US dollar, and I think US falls short of having sufficient gold to convert all the US dollars that they have at their reserve. So therefore, I think they took out the system, they replaced it with US dollar. So therefore, in our conventional monetary system, we have seen many of the central bank reserves are also holding US dollars, but not gold. So eventually, I think this is something that we should take note. If you compare over the past century, I think gold against the currency itself, majority of all major currencies has lost its value, at least 97 to 99% if you compare to gold prices alone. So in this kind of environment, obviously it's very tough to predict whether we eventually will end up back into the Bretton Woods or scenario. We will never know. But gold definitely prove a point that is a store of value throughout the whole year, the whole years. So I think this is something. If you're a firm believer, as major economies are printing money, devaluing their own currencies, I think gold could be in favor in this type of scenario. Now, I think this is a much of talk of town, the recent trade war that's happening between US and China. Now, how this relates to gold, let me explain in brief. We have seen how US started sort of like a trade war with China by imposing US steel tariff. If you just understand this in deep, US import, if you just look at imports, US imports steel from China, the percentage itself is not much. Majority of the steel coming into US is actually mainly from Canada and Mexico, some of the major countries that's nearby to US. So having US imposing a US steel tariff, hike, may not have a significant impact to China. But that, nevertheless, I think that caused retaliation effort from China itself. Since US has initiated a trade war, we have seen how China responded by imposing a similar trade tariff on certain US goods. There's about 50 odd items on the list, and this creates a retaliation effort from China. So if this were to continue to persist, I think market will be quite volatile. Now, this is the list of China retaliation towards US goods. So the list, these are the short list. They have a longer list. There's a total of 55 odd items in there. Now, I just want to bring your attention to China appetite for commodities. I think back in the earlier agenda, I mentioned China being a very big market, and you just look at the composition of China in any of the particular commodity. You just look at cement, they are 50% of the global demand, and you look at aluminium, it's close to 50%. So China itself is a very big market for commodities, and in the current US tariff, US and China trade war they are seeing, I think one of the major commodities that could change or could alter the game is, in fact, soybean. Soybean is a very important commodity for China, and the major exporter of soybean is US. So we have not seen China imposing any tariff on soybean yet, but if it does, I think that could have a very grave impact on US market when it comes, especially on the grains market, because US ultimately is one of the largest supplier of soybean to China. Obviously, China has a contingency plan. China can always shift their buying to South American beans. Brazil and Argentina are also big suppliers of soybean. So this is something to watch out in the trade war space. And I don't think that any action will be taken in the immediate term when it comes to soybean, because it's a major commodity that it involves the two party. Okay, but if you just look at in general the commodity basket alone, I think China has a huge appetite in some of the major commodities. Now, China itself is not a rosy story. If you just look at how the economy has performed, despite registering 6% on average in terms of their economic growth, we still see huge amount of debt that China has been accumulating over the years, and this could actually be an impact. But given the fact that China is still pretty much a controlled economy, the government could step in any point in time to deflate the pressure on debts. So it may be a concern in the short term, but over the mid to longer term, the government will come into play. Okay, again, this is dollar-denominated debts. The interesting part, not only trade war is happening between US and China, the second main thing is also currency war is happening between the US dollar and the RMB. So this is again another interesting front that you should watch out over the coming weeks as how this will unfold. Okay, now this will create another next angle which is very critical to the overall story between US and China, and this will relate to the petrol yen oil contract that was just launched 2 to 3 days ago. Now in this new oil contract, it was mentioned that oil will be denominated in RMB for the first time, and it's open to overseas investors. And the good thing is that these oil contracts are convertible to physical gold. So this is something of a major development, especially if you look at the China market. The quantity to gold will be very interesting. And if you just look at how China has been buying a lot of gold for the past couple of years, I think China is actually gearing up for such a contract. Because given that oil contract is still a very big contract to be traded on the market, and it gives assurance by allowing these contracts to be convertible to gold. But having to do that, China has to have a huge holding of gold. And you have clearly seen over the past 2 or 3 years, China has been actually accumulating a lot of gold on the open market. So this is seen as a step to bolster the demand for gold, especially from China. And if you just look at this, could be a potential price support for gold prices. So if you just look at China itself on the oil space, I think China clearly is a major oil importer in the global markets. It has clearly surpassed US. So China is a dominant player in the oil market. So having this contract will further risk US position as the #1 oil price benchmark position. Okay, so petrol yen is something, the new petrol yen contract launched by China in the past couple of days is something to watch out. And because of convertibility to gold, it's actually indirectly it gives a greater demand for gold if people are trading those contracts and converting them to or demanding a gold in exchange. So gold will definitely be in favor, and China, as we reckon, will continue to buy gold to boost up their reserve. Okay, so that leads to the final story, which is the US dollar. And because as a result of this, I think US dollar could have an impact, and with oil denominated in yen, in RMB, no longer gold can be transacted. Oil transacted in US dollars. That will keep the US dollar out of picture. So the demand for US dollar will be actually being questioned. So as we move towards the next couple of months, and further contracts will be traded on this petrol yen, I think the demand for US dollar will start to be weaker. So this is something that's to watch out on this space. And I think definitely the strength of the US dollar will definitely be tightly watched. Next bit, here's just to show you the gold against silver ratio. Indirectly, all in all, what I'm trying to show you in this chart is over the past many centuries, if you just look at gold against silver, gold is definitely way overpriced more than silver in multiple times. But I just want to share with you the ratio between the gold and silver. At the current point in time, the ratio is between 70 to 80 times, whereby gold is trading at a premium compared to silver. So as we noticed for the past couple of years, whenever the ratio hits about 80, the valuation in terms of silver is undervalued, and for gold is overvalued. So we see more upside in silver compared to gold. But naturally, when the precious metal space pick up, in general, gold and silver will tend to pick up as well. Now, in terms of ETF holdings, this is just to reiterate the point that I think gold also pick up in the past couple of months as the general holdings in terms of their ETF has also picked up. Now, this is a critical chart which I like to share. with the audience here today is actually to compare the seasonality of gold between the different months. Now, the green color is to indicate month-to-month positive in terms of price, and red color means is to indicate the price change negatively month-to-month basis. So if you look at it, if you just see the breakdown, generally we can conclude February, August, and September is usually the strong months. Strong months here refers to more greens rather than reds. And if you just look at it, weaker months are like March, June. In fact, May could be also a weak month. So based on this 20-year seasonality, you normally, if you have a futures contract, you long on the positions or the months that usually is stronger, and usually you short on the months that usually is weaker. And I think generally, gold has quite a good seasonality pattern. If you look at other commodities, it will differ accordingly based on the fundamental. If you look at grains market, it has a different seasonality pattern as well. So gold seasonality pattern is quite obvious. So just to conclude on the seasonality pattern review, January, February is usually positive months. Second half is, in terms of price volatility, is greater compared to first half. So if you are trading in the futures market, do beware when you're approaching the second half of the market, because you could experience a greater price fluctuation. Then if you look at in terms of monthly price change on average, you are looking at about 8%. So if you are trading in the market, you want to set your stop loss, those are the percentage that you're looking at. Now, August and September are also the strong months. Strong months here refers to months that are positive in general. So August and September are also good months for you to go long into the market. But June is the month where usually is the weakest month, and that's where the month that you should be short in the market. Now, coming back into a little bit on technical side of things, we just look at, this is the gold chart that I have here. Just to show you, I think gold create a very important support at 1,300 US dollars. If it does break that, I think it spells for a downtrend for the general gold market. The resistance we can clearly see is at 1,380. If it breaks that, I think gold will be on an uptrend again. So generally, if you look at it, gold is still an uptrend, but it's generally supported well at 1,003. So do watch out if you are trading the market. Do watch out prices retreating to below this level, because it will mean that it break the major support level at 1,300 US dollars. Now, that again, we try to transition it to the dollar index, and if you just look at dollar index itself, dollar index is actually approaching what we call a technical term called death cross. I just painted here a two moving averages line. One is a 50 days moving average, another one is 200 moving days average. You just look at where dollar index is, it broke both of these lines, and it's actually spelled for further downside for the dollar index. So with dollar index expecting to hit lower, and if we understand the relationship between dollar index and gold, we can clearly see gold could be well supported because of the weakness in dollar. And if this were to continue, we should see further upside in gold over the mid to longer term. So coming to conclusion, in terms of price forecast, like I mentioned, the short-term resistance we've seen at 1,380. In fact, if you look at short-term wise, we should see a bit of correction going forward, because as Federal Reserve hiking interest rate in the next couple of months, it actually may not be benefiting gold in general. But over the medium to longer term, given the uncertainty that we're seeing in the market, given the strong demand that's coming from China, we should see gold to be fairly bullish, and should hit to 1,380 resistance level. However, if there's a correction in the market, we recognize 1,300 US dollars as the key support level, and if it does break that, that will mean further downside for gold is expected. Now, in terms of fundamental space, we have not seen any big significant change. We do have to just watch out on China, because China has been quite aggressively buying in the market for the past couple of years. So it's a question to us whether China will continue to buy, and I think that remains to be seen. But given the new contract they just launched and is convertible to gold, I think China demand for gold will be sustainable going into the future. So given that, we are looking at prices trading between 1,280 to 1,360 US dollar per ounce for the rest of the year. The key thing is that we're still looking at prices to be still above 1,003. Just that we're just afraid of the rising interest rate. If it's too steep, that could mean a stronger dollar, and that could actually affect gold in general. Okay, now last bit, I just want to share with you commodities correlations here in this table. So here, this table depicts all the different commodities, the relationship between each of the commodities. So if you are trading in the market, and if you are trading a different type of products, the relationship between different type of products, the commodity space, the correlationship space is very important. Obviously, if you talk about precious metal space alone, gold will have a higher tendency price reaction towards silver, platinum, which is in the commodity space, but yes, less significant to other like oil products like gasoline and other products. But just look at gold and dollar. Gold and dollar is a negative relationship, and the correlationship is 0.506. That means it's a 50% chance that's negatively correlated. So based on this table, you can clearly indicate how each of the commodity correlate to each other, and from there you can make judgment on how you're going to trade if you're trading in a commodities pair. Okay, so some final points. Go forward curve. If you're trading on a futures market, you do have to take note on forward curves. Forward curves refers to the price structure for different type of products, and gold forward curve is very unique. It's always in a contango market, or rather at most times in the contango market, because of the interest rate cost and because of the cost of carry. Okay, but if you are already trading in the market, and if you are trading a COMEX gold that's available on a CME exchange, do take note that the active hours are between 9:30 to 2:30 a.m. Not very Asian hours friendly, but during those times, it will get very volatile. Okay. If you are talking about worst drawdown, if you are controlling your risk management, the average single day drawdown in terms of gold price is usually between 9 to 11%. So that will give you a bit of sense how you can manage your stop loss, or at how many percentage of stop loss that you can buffer in terms of the capital that you're willing to risk. Then last but not least, economic announcement is very key, and this refers to US economic announcement, especially when it comes to non-farm payroll days, when it comes to economic data driven days. I think markets will be very volatile, and gold in general will also move very volatile. So do watch out. If you want to trade on those days, you have to be a little bit more careful. Okay. Now these are the three major products on the gold market on the COMEX exchange. So it depends on how big of an exposure that you want to take. The gold itself is 103 ounces contract. Those are the trading hours. The mini gold is 53 ounces. The micro gold is even a smaller contract, is 10 ounces. So we have many different type of contract sizes to fit your needs. So if you're already getting an exposure, do look into these three contracts that's being offered by the COMEX exchange. Okay. Now, as I was saying, why should you take an exposure? There's many ways for you to take an exposure in the gold market. Obviously, one can always go to a physical market and purchase the gold itself on the shelf, or you can have a gold saving account, which is very common in banking institution. Or lastly, you can go into the futures market offered by Phillip through the CME exchange. If you just look at the major difference, gold futures gives you, first of all, leverage. And if you're already talking about physical market, it's always very tedious for you to keep the gold. In fact, you actually incurring further costs. So if you take a futures contract, you don't have to go to the hassle of thinking where to store that gold and whatnot. So gold futures actually, in fact, it's a very cost efficient way to gain your exposure in the gold market. And obviously, the term, you can do a short term trade, probably in seconds or in minutes, or even an intraday trade. You can go for mid-term, you can even go for long-term using the futures contract. The CME, the gold exchange on the CME exchange is deep enough, is liquid enough. It has contracts up to 2023. So you have a view on gold for the long term. It has a contract for you to position your views on. So gold futures is a better way, if you look at it, it's an efficient way for you to gain an exposure in the gold market. So with that, I'll take questions, and I hand it back to Sri.
All right, thank you so much, David. It was quite an insightful presentation. I believe the audience will find it very useful as well. Well, we still have time for a few more questions. If you have any questions at all, feel free to leave them in the question box so that we can pick them up. Just a few more before we end the session, and I'll proceed to ensure that this webinar is recorded so you can revise it later on this week. All right. It seems like it was quite. I mean, you have covered most of the talking points during your presentation. Before we end the session, we have one question from Louis as well as Jaylin. David, would you be able to address that?
Yeah. Thanks, Sri. Okay, I saw some questions coming in. I think one of the questions is, instead of physical gold positions, will it be easier to buy GLD ETF or rather ETF in general, gold ETF in general? Now, I think if you look at it, always the questions are liquidity and cost. ETF may provide that kind of liquidity similar to futures market. But when it comes to cost, because generally ETF, it depends on the broker that per se. Obviously, the cost that you may save is futures. You have a rollover cost, you have a transactional cost. But if you look at it in general and you sum it up, I think the transactions to go into the ETF still relatively a bit more expensive compared to a futures market. But then again, if you look at liquidity wise, and you look at the spread that's in the futures market, it's still definitely a better spread compared to ETF instrument in the gold market. Now, next question: why are we seeing the dollar index going down while Federal Reserve increasing interest rates? Now, this is a very interesting question. Now, I think the dollar index is not only a factor of the interest rate itself. It's also a factor of other elements, and I believe the other elements are relating to first of all the role of US dollar itself, and the other economic fundamentals that's developing in the market for the dollar index. Even we see rising interest rates, and if you look at historically, rising interest rates should accompany by a rising dollar, but we have not seen that. I think, in fact, if you just look at how China has been aggressively, from the backdrop, selling treasuries, selling US treasuries, selling dollar on the open market, is telling a tale that the demand for dollar may not be there. So eventually, dollar will become weak. This is also a part of factor, and this will negate some of the effect of a rising interest rate environment. So this is another space that's worth watching, and with the continued ongoing petrol yen contracts that's in the market, I think US dollar itself could be in precarious position. Okay, Sri, I hope I've addressed most of the question.
Yes, you have, David, and thank you so much for joining us today. It was very nice to have over 80 of you tune in and listening live for this webinar. Till our next webinar, we'll send you the link to the video so you can revise it, and do look out for our emails on the next upcoming webinar. Till then, have a good night and have a great week ahead. Bye-bye.
Thank you, Sri.
Thank you, David. Bye-bye.